Your 401k plan is designed to be used specifically for retirement. But what happens if you need to use or tap into some of that money before you reach the age of 60? I'm going to go through 9 of the reasons why you may want to consider taking money out of your 401k and how to do so without incurring a penalty. First, let's talk about that penalty. The IRS incurs a 10% penalty for what they call early distributions or early withdrawals. Meaning if you're under the age of 59 and a half, when you withdraw money from your 401k, if it's not used for a specific reason, which we'll go through in a moment, they will incur a 10% penalty on the amount that you withdraw. And that 10% penalty won't be assessed immediately. You'll just have to cash flow around that and plan around it when you file your taxes in the next year. So what are some ways around this? Well, number one, first, it helps to live to 59 and a half. So if you reach the age of 59 and a half and you decide that now is the best time to retire, you can then start taking withdrawals from your retirement account without paying the 10% penalty on those. The 59 and a half rule is pretty straightforward. Once you hit that milestone, the IRS says, well, these distributions and withdrawals are no longer early. You've reached the age of 59 and a half, you've reached the pinnacle, and you are now able to take money out of this without incurring a 10% penalty. This includes money in your current 401k with your current employer. It also includes previous 401ks from previous jobs that you've had. Number 2, separation of service or the age of 55 rule. So this rule is often misunderstood, but the basics of it are this. Once you reach the age of 55, if you have now retired from your current job, you can start taking penalty-free distributions from your 401k as long as the distributions are coming from the 401k in which you just retired from. So this does not apply to 401k plans from previous employers. This only applies to your current 401k from your current job. Number 3, substantially equal periodic payments, or SEPP for short. This is also known as the 72T rule. And this allows you to take substantially equal payments out of your 401k plan if you're under the age of 59 and a half without incurring a penalty. There are specific rules, though, that you must follow. Under the SEPP rules, there are three IRS mandated ways to take money out without incurring a penalty. Number 1, required minimum distributions, or RMDs. Number 2, the fixed amortization method. And number 3, the fixed annuitization method. These payments must continue until you reach the age of 59 and a half or for the next 5 years, whichever option is longer. Number 4, a disability. If you're permanently disabled, you can access your funds penalty-free from your 401k plan. To qualify for this, you've got to be able to show documentation to your plan administrator. So if you're receiving disability payments through Social Security, if you're receiving disability payments through a long-term disability plan that have shown proof that you're permanently disabled, you'll be able to show those as proof of your disability and be able to take withdrawals penalty-free. Number 5, if you have significant unreimbursed medical expenses, you'll be able to take money out of your 401k penalty-free. Now, these are medical expenses that have been unreimbursed, right? So not expenses, obviously, that were covered by insurance or were co-pays or deductibles. These are unreimbursed medical expenses and typically pretty significant. To qualify for this, the medical expenses have to have exceeded 7.5% of your adjusted gross income, or your AGI. Again, you'll need to show pretty significant documentation to be able to prove this, but you would then be able to show that documentation to your plan administrator for approval. And while the penalty is waived, you would still pay federal income tax and state income tax on your distributions, assuming the money has been tax deferred. Number 6, health insurance premiums. So you can't use 401k funds to pay for health insurance premiums, but if you're unemployed and have been unemployed for 12 consecutive weeks, you can take money penalty-free out of your 401k to pay for health insurance premiums. You must keep records for your unemployment and your insurance premiums to be able to qualify. Specific documentation is really important, especially for these types of medical payments. Again, although you may avoid the penalty, you may still have to pay taxes on the distribution. Okay, and lastly, rolling over the funds into an IRA or traditional IRA. If you're retired, pretty simple. You've got your balance in your 401k, you can roll this over into a traditional IRA without any penalty or taxes. But what if you're still working? Can you roll over the 401k into an IRA for any reason? If you don't like the investment options or you just want to provide some more flexibility with the account, it depends. So in some instances, depending on your plan, if you're over the age of 60 and you're still working and you don't plan to retire anytime soon, you can do what's called an in-service distribution or an in-service rollover into a traditional IRA that you have set up. There's no penalty, there's no taxes, as long as it's going from pre-tax 401k to traditional IRA or Roth 401k to Roth IRA. So you've got to be at least the age of 60 to be able to do this, and the plan has to allow it. That's the key. Not all plans allow for in-service rollovers. So in summary, navigating the different waters on how to take money out of your 401k without penalty can be confusing. There are ways around it though. Not every 401k is locked up to your 60. You do have access to this money for extenuating circumstances in your personal life, or if you reach certain milestones with age. There is an option also in most retirement plans for you to be able to take a loan. I typically recommend against it, but in most, if your plan allows it, it does allow you to at least have that emergency where if you needed to take money, you could take a loan without any penalty or income tax. Now, just like with any loan, you've got to pay that back. And with most plan administrators, they require you to start paying that loan back immediately. You can extend your loan repayments out to 5 years. Obviously, the further out you extend, the lower your repayment, and you can pay it all back at once. There is, like most loans, there is interest associated with it. Because interest rates have been so elevated over the last couple of years, it's around 8 to 9%, depending on the custodian. But that interest goes back to you. So you're essentially being your own bank. That interest does not go back to the provider of the 401k plan. So there may be pros and cons, but if you take money out and the market does well, you've missed out on those gains. It could be the other way too. So if you took a loan and the market drops, then you've saved yourself a little bit in unrealized losses too in the 401k plan. So just remember with loans too, this is important. If you're contributing pre-tax into your 401k, meaning you're deferring that income into the future, and you take a loan, your loan's not taxed and you're not penalized on it. But when you make your repayments on your loan, those are coming out of your personal checking account. So those are used with after-tax dollars. So you've made a pre-tax contribution, you've taken out a loan, you're paying it back with after-tax contributions, and then when you take the money out in the future after the age of 60, you don't pay any penalty, but you'd be subject to ordinary income taxes in the future too. So you're paying taxes twice on the money that you took out as a loan, instead of just once if you just kept the money in the plan. So a lot of different options. Speak with a professional if you're not sure which option to take. And of course, we're always here to help.